You are listening to Keystone's Stock Talk Podcast, episode 168. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We're back following a week in California at the LD Microcap Conference. From approximately 200 companies attending, we interviewed roughly 20 management teams, and I will highlight a couple of companies of interest, including Richardson Electronics, RELL on the NASDAQ, DocGo, symbol DCGO on the NASDAQ, and DMG Blockchain Solutions, symbol DMGI on the TSX Venture, as well as a couple of companies currently in coverage, including Geodrill GEO on the TSX, Quipt Home Medical, QIPT on the TSX, and Acme United Corporation, ACU on the New York Stock Exchange, that we happen to sit down with at the event as well. I will also look generally at the markets in light of the significant market correction, which borders on a crash in technology and risk assets. In our Your Stock Our Take segment, Brennan answers a listener question on Nutrien Ltd, symbol NTR on the TSX, one of the world's largest producers and distributors of potash, nitrogen, and phosphate products. Brennan answers whether or not there is value in the business in the current volatile environment. Finally, Aaron answers a listener question on lockdown and work from home darling Docusign Inc, symbol DOCU on the NASDAQ, the world leader in digital signatures, which has seen its share price drop 64% year to date and over 80% from its highs in 2021. A listener asks if we are starting to see value in this battered tech name. So let's get to the show. Welcome, Aaron and Brennan. How are you guys doing? Interesting markets right now. I note the Dow plunged more than 700 points today. The NASDAQ getting hit very hard, fell 4% again today. S&P 500 erased now 2021 gains as recession fears mount.
Yeah, it's messy out there, particularly for the technology sector, which is just getting no reprieve at all. There is a little bit of a move up, a week ago, but it's really it's continuing to get hit hard. And a lot of these companies, it's crazy to say, but we're looking at companies that are down 60, 70, 80%, and the valuations still look expensive in some cases. In some cases, the valuations are actually starting to look attractive for some very successful companies. But in a lot of cases, you're still looking at companies that are trading at 50, 60, over 100 times earnings, and that's after a more than 60% decline. So that just shows you what the valuations were like at the peak, and maybe how necessary it is that, particularly in the technology space, there needed to be some pressure taken out of the bubble. But, when you talk about crashes, corrections, for much of the technology sector in the US, it's been a crash. When your stock price is down 80%,
at this point,
80% over the last year. And in some of these cases, speculative companies, in other cases, actually profitable, good businesses. But, that's a crash. So, the question is, are you owning the right stocks? This is really a lesson to investors in terms of just, following the herd and paying any price for something. In many cases, companies that weren't actually making any money. Maybe they were generating a lot of revenue. The revenue growth was really exciting, but they weren't producing any cash flow or earnings on the bottom line. But trading at valuations, 100 times sales. 100 times earnings is expensive, but some of these companies trading at valuations of over 100 times sales, and people buying it because quarter after quarter, year after year, these stocks were performing. But now, in a matter of months, years in some cases, of returns just basically being wiped out.
Yeah, and it may get worse before it gets better, but we are right now aggressively looking at over 400 names in the U.S. to see if we can find some babies that got thrown out with the bathwater, companies that we wanted to own for years that were just too expensive. And, it really shows you when Aaron was talking about there, what we talked about at the start of the year, valuations, and even into last year, all the way through 2021, really. Valuations appear, again, starting this year to matter once again. We talked about that starting to inch into the market. Our theory was that companies priced at premiums, or quite frankly, in many cases, ridiculous valuations, would suffer the most in 2022 if the market focused back on cash flow to value stocks. And that, with the fears of inflation, with the fears of a recession, that's what's happening right now. And you just look at some of the relative performance year to date of, indexes. You can just look right now. I mean, the NASDAQ is down over 33% year to date. Bitcoin is down like over 55, almost approaching 60% year to date. Assets that are, Bitcoin, very difficult to value, no cash flow. I can't value the business. So we've been talking about that and detailing that for a couple of years now. But, you look at, is value mattering? Does it matter? Like, are companies that actually had value at the start of this year, even if they are hit, are they getting hit to a lesser extent to the companies that had sky high valuations? Well, I'll just pull up. I mean, Aaron's going to talk about Docusign and the declines that you've seen there. That is a company that certainly for us was priced at ridiculous premiums. You look at a company like Shopify, down 78% just year to date this year. Whereas Alphabet, which is a company that we've held for a number of years now, is down about 26%. And, the entire market is down around 33% in the NASDAQ, so it's down less. So to me, that does indicate that while there is some indiscriminate selling, and we're going to try to take advantage of it, there is some rationality to the selling in that the companies that are getting punished the most are the companies that were trading at just frankly ridiculous valuations. And that'll be, I think, a theme that we'll be looking at today in the show. And we'll also look at going forward and trying to find some babies that get thrown out with the bathwater. Like we said, really good companies that get sold off, maybe 40%, 50% even, that 3 to 5 years out, you'll really want to have at these levels in your portfolio and can be game changers once again in your portfolio. And there may be some really strong opportunities over the balance of this year, and that's what we're looking for right now. I don't know if you guys want to follow up any further on that. I just thought I'd go through the notes of kind of
one thing
the overview of the LD Micro.
One thing that I could add, just in regards to the Bitcoin.
Oh, Brennan,
crash
you're here? I didn't even know you're here.
Yeah, I know. I've been quiet over here. Like usual, I kind of let you guys run. But yeah, so just going back to Bitcoin, like we have seen it, like Ryan said, down about 56% year to date. And I just want to push back on, some of the people early in 2021, they were saying that, Bitcoin's this safe haven asset. Even in our 2021 prediction show, I ended up saying that, or referencing that CoinDesk Research claimed Bitcoin was now potentially a safe haven asset, as they said that Bitcoin had about a 0.25 correlation with the S&P 500 during the last 90 days in 2020. Well, that's completely reversed right now. I mean, looking right now as the market's been absolutely sliding, let's just relate the returns of gold versus Bitcoin. Year to date, gold has done about 1.2% to the upside. Like I said, Bitcoin's down 56%. 1 year out, we're looking at gold up about 2%. Well, again, Bitcoin's down 46%. Now, of course, looking longer term, Bitcoin is still up 730%, while gold is only up about, 47%, which is still huge. But again, it's, a lot of these talking heads online were saying, you gotta hold Bitcoin. It's a safe haven asset now. It is the digital gold. Well, not so much, I think, as we're looking at it. And even in that prediction show, I did, say my skepticism towards it, just towards, the volatility of it, the actual use cases of Bitcoin. I know that maybe that's a good segue where Ryan actually did, or we talked to some Bitcoin companies, down in California about the use cases. And I mean, there's use cases for gold. Between 2013 and 2017, 54% of all gold was, actually used in jewelry. So, there are use cases for it. Bitcoin, not so much. Anyways, that's my 2 cents.
And I posed the question, and their biggest issue, and they talked about for just gaining further acceptance and gaining further investors in any cryptos really is having a use case for these, for the underlying technology of blockchain, essentially. And that's what they were talking about is necessary over the next 2 to 5 years. So those are coming straight from, CEOs of companies who operate within that segment, who live and breathe this every day. For us, it's, people ask, is now Bitcoin undervalued? There's no underlying cash flow. It's just, and we like to keep it simple. It's just very hard for us to value Bitcoin, and gold for that matter is difficult to value, to be honest. So asking us, is gold under or overvalued right now? But, we can give you, we'll look at a couple individual companies today and we know their cash flow, we know the dividends they pay, we know if they're growing, if there's a growth outlook going forward, and we can give you a broad range of what we think the value of the company is based on their cash flow and their growth going forward. Assets where you like a Bitcoin or a gold, it's very difficult for us to value. And I think we've seen models on how investors try to value these assets, and for us, it's just very difficult, and I'm skeptical whether any of them would work with any degree of success over the long term.
Just on the topic of valuing something like gold, I mean, by the way that we value investments, as Ryan said, we're valuing them based off the cash flow that these productive businesses produce. So something like gold, there is no cash flow, there is no business, there is no innovation, nothing. So it's really just a shiny metal. But Warren Buffett, this was years ago, I read in one of his annual meetings, he talked about gold and did his own style of valuation. So essentially he did a calculation. He figured if you took all the gold in the world, I might be a little off in the numbers, but you'd basically get a cube, the size of a couple football fields long, right? And he figured out what the value of that cube would be.
Yeah, and it might even be smaller than that. I've heard.
Yeah, it could have. Maybe it was one football field. This was years ago that I read this, right? But he figured out the value of that shiny cube, and he's, there's not really much else to it. It's a nice yellow piece of metal, big piece of metal, and it doesn't really do anything else for you. So he compared that to what you could buy for the combined value at the market price at that time for that cube. And he figured out it was essentially all of the farmland in the United States plus five of the top most profitable companies in the world, the largest companies in the world, and then with a whackload of other assets and cash left over after that. So he said, from his perspective, would I rather this big yellow cube that doesn't do anything for me, or all of these other productive cash flow producing assets? And for us, it's really not even discussion. We would want the productive assets that we understand that are actually vital for the survival of the human race and the progress of the human race. I mean, that's an investment.
Yeah, so I got the exact quote here. If you molded all the gold in the world into a cube, Buffett said it would be about 68 feet per side. This is 4 feet shorter and considerably wider than a tennis court. So it's
crazy. And
it would fit in the middle infield of a baseball infield, essentially, right? And, and that was a while back, right? And then he talked about then, what you could buy with all that. And it was unbelievable, right? Like he said, you'd be sitting on, at that point, 10 trillion. Observe that buying the cube, you could buy all the cropland in America, worth 400 billion at the time, 16 Exxon Mobils, and you'd still have 1 trillion of walking around money. So
sure.
It's a great analogy to use. Which would you rather have? I don't know. But I mean,
and then you reduce that down to every
assets.
Unit of your own capital, every dollar of your own capital. I mean, if you're what are you voting for? Productive assets or something that's just depends on the psychological value that people assign to it?
Yeah. No, I
And
agree.
gold, during a time that you would think it would have been a great place to be, has actually not been a great place to be.
Relative to Bitcoin, though. In the last
Relative to Bitcoin.
Yeah.
But
that's
do
true.
we even put it relative to it? It's a discussion that could go on for another time, I think. Now, I'm going to look at my quick review, mine and Brennan's from being at the LD Micro. My notes would be, number one, I'm going to say travel today sucks.
Yeah.
I'm going to say Brennan missed the first day of the conference due to flight delays, and my 2-hour and 50-minute flight home turned into an 8-9 hour adventure at the LAX airport. So staffing issues at the airlines and airports continue. So what I would say is, if you're planning trips this summer, have fun flying, because we did about 3 research trips over the last 2 months. No, I don't think one of the flights didn't have some kind of delay, baggage delays, and sometimes it's first world problems, but they were. The airports just aren't ready for the travelers, and the airlines let off too many people.
Yeah, exactly. If you need a layover, make sure you at least plan for 3 hours. I know we talked to another individual down there. Plan for 3 hours. My layover was only an hour. That's why I missed the first day of the conference. Anyways, continue, Ryan.
And we hold it against you, not the airline.
Correct.
But
Of course, when you do that, your connection is then going to be delayed 3 hours. So it's,
Of course it will be 3 hours and 10 minutes, and you're done. Now, I'm going to look at companies of note. We interviewed almost 20 companies down there. One, it was Richardson Electronics Inc., symbol RELL on the NASDAQ. The numbers from this company, they actually announced them the day of, the event starting. Fourth quarter sales preliminary were up around, should be up between, around 20% to around 61 million. Growth is coming, and that's from the prior year's fourth quarter. Strong end market demand and successful new product expansion initiatives. They announced their fourth quarter backlog was up to 206 million. From 175 million at the end of the third quarter. And year over year, last year, this time the backlog was 110 million. This time it was 206 million. So strong backlog growth there. So it's an interesting business with solid growth and valuations. They look reasonable. It pays a dividend. Would likely be vulnerable in a recession. So we do have concerns that the record backlog may include some safety stock buying from end customers given the current supply chain issues. But it does look interesting. The company reminded me a bit of Hammond Power, a company that we have under coverage now, in that it is in the electrical industry to a degree. It's been around for 70 plus years. Hammond's been around for over 100. And the current CEO, Edward Richardson, bears the company name, having had the business passed on through his father, as is the same case with Bill Hammond of Hammond Power. So Richardson, for me, does appear to be a bit more of an innovative company. So it is a company in this segment to take, it trades at reasonable valuations, and we're continuing to do our due diligence on the company. The next company I would note is DocGo, symbol DCGO on the NASDAQ, operates in the medical transport and mobile health end markets, provides scheduled ambulance rides and last mile mobile in-home healthcare. So the company is generating solid cash flow. As at the coming quarter, should have approximately 200 million in cash on the balance sheet with no debt, basically. Access to about $150 million line of credit. So good balance sheet to start. Total revenue in the first quarter was 118 million. Now, about 38 million related to COVID testing. That's going to run off over time, but the company was profitable, 9.6 million compared to, or 9.4 million compared to a loss of 2 million in the first quarter the previous year. So some of the issues that the company faces, COVID revenues in the first half of the year should be in the range of 58 million. Now it's expected those revenues will go to zero in the second half. So the company must grow non-COVID revenue, which it is growing at a strong clip, about 10 million sequentially in both Q3 and Q4 to achieve the midpoint of its guidance, which is for solid growth overall this year. So it does appear that, they're on track to do that. It's profitable, good balance sheet, has sold off. We're looking closer at it right now. And, it does seem to, as they are promising to grow margins if they can uptick the margin profile and grow revenue and, get away from those COVID revenues, which, looks like they are, it's interesting, and it's, definitely profitable, not on an adjusted basis, profitable just on a GAAP income basis. So an interesting company. Finally, I would note DMG Blockchain Solutions, DMGI, and the TSX Venture. It's a vertically integrated blockchain and cryptocurrency technology company. Basic business that makes its money is as a crypto miner. It mines Bitcoin. Q2 revenues for this year up 377% to almost 12 million. Earnings per share were 3 cents in the quarter, up from a loss of 1 cent. So strong balance sheet here too as well. Net cash position. They trade at under 30 cents. They're profitable, like we said, but they're tied significantly sentiment-wise with Bitcoin and crypto generally. If you see a crypto winter, they could still be profitable. They won't be as profitable as they were in the last quarter, but the sentiment in the sector won't be behind a high multiple on it. But if you were favorable on that segment long-term in Bitcoin specifically, it is a company to keep an eye on in that segment. We also talked to Geodrill, Quipt, and Acme United, like we said. All from our current coverage that we're at there, sat down with management teams. The first two, Geo and Quipt, reported robust business as we've detailed the clients. And United faces good business, good growth, but costs are increasing. The company expects margins to return to normal by year end. Interesting, we talked about all those losses in the market year to date. I just did a year to date quickly on those three companies. Geodrill is actually up 11.1%. Quipt, being the laggard of that three, is down 16%. Well, Acme is just down around 7%. So you put that, next to Shopify, which is well known, but is down, and had tremendous revenue growth, but doesn't have the underlying cash flow or price to cash flow multiples that those three business does. It was down 78% year to date. The average of these companies are probably down around 5%, and one of them was actually up in a terrible market. So really small caps, which are all those three are, should be more volatile and should be subject to more volatility than the general market, particularly in these times. So when the market is down, say 30%, in theory, the higher risk profile generally of these type of companies, smaller companies, they should be down 40+%. In the case of these three, their cash flow has likely held them into the positions that they're relatively trading at the start of the year. So it reinforces the fact that what we talked about in a market focused on value and growth, businesses like this can do better on a relative basis. So I would say we're going to expect further volatility and weakness in many tech names that were bid to unrealistic valuations through 2021. But this is where, like we said, huge opportunities will emerge. This is why we are authoring a special report on the crash in U.S. tech, what to avoid and what to start buying. And we'll release that shortly. So hopefully we can come up with some new buy recommendations. We may just put our toe into some companies we want to own for the next 3 to 5 years, buy 25%, 50% positions in those companies to start. But there are some good businesses that will be sold off in sympathy that may come into a range where we, want to own them today, but really specifically want to own them, want to look back and say we took advantage of a period of fear and bought them. When we look back 5 years from now, we're happy we bought them at whether it's today's levels or by the end of the year, we'll see some value in the market, which would be nice with growth.
And I think when you're looking at a market right now where there's so much negative momentum in share prices, you don't feel, as an investor, in a lot of cases, there's not really a need to become fully invested with all your available capital right away. Just take a gradual approach. Just set, a certain amount per month even that you're allocating to your investments, buying stocks. And that could be the same on an individual company. I mean, you may see a company that you like, the numbers start to look good, the outlook long-term looks good. You may want to start with just a quarter position, maybe a half position, and then over the next several months or a couple of quarters, you just continue to fill and then work your way up to a full position from there. With a lot of these companies, there isn't really a sign right now that the negative momentum is over. for many of them, there's probably a lot of downside yet to come. It's really difficult to get in exactly at the bottom. So one way to, limit your risk while also getting invested in some interesting names is just by starting with the smaller position and gradually increasing it over time.
Yeah, and I agree. And the great thing about, I think, this report we're coming out with is you can see, like, we're covering like 50 of the biggest software and SaaS companies that are great. Many of them are great businesses, but they were trading at unrealistic valuations. There is a few of them that are coming into more reasonable ranges, and we'll be looking at those on a comparative basis relative to each other. Where is the value in these names? Like where, now we'll answer the question after Shopify being down 85, 90, almost 90% at some point from its highs. Is it finally a value? Is Docusign a value? Is Square? Is Splunk, Smartsheet, Coupa, Zscaler, Palantir, Autodesk, ServiceNow, all these companies that hit dizzying levels but now have come down, many of them 50% plus. Which ones? Because again, many are businesses that we all use or many use, and we see tremendous growth in them. But what is the valuation that you should be paying for these? There's only a few of them that we've owned. We think we'll add some more over the course of this year, and I think it will be a great opportunity. Again, when you look back, 5 years from today, you're positioning your portfolio today from where that portfolio should be in 5 years. Okay, now let's answer a couple questions here. The first one, Brennan, you got asked a question on Nutrien. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Nutrien, sorry. NTR on the TSX. And let's let you answer that.
And that's a Saskatchewan-based company, is it not, Brennan?
Ooh.
It is Saskatchewan-based.
Right,
I got to point out, we told everybody, I made a point to tell everybody we're interviewing down there that Brennan is from Saskatoon, Saskatchewan. Many of them just, first of all, they can't even say it. Second of all, they're like, that's a made-up place. That doesn't.
Yeah, no, let's be honest. Sure. This is how it actually went. We would sit down. Ryan would say, I'm from Vancouver, and he'd look over at me and be like, my colleague over here, Brennan, is from Saskatoon. And then he'd ask, do you know where that is? That's usually how it went. And they usually didn't know where it was.
In between there, Brennan would fall out of his chair and then have to get back up.
No, but it was funny. And I'm proud of being from Saskatchewan. So, I rolled with it. And I'm glad
and should we tell people that we went to a movie together?
We did go to Top Gun. It was pretty good. Everyone should go to the Top Gun. I have actually seen the
Brennan
first
enjoyed
Top Gun,
the scene where they were playing football on Brennan really enjoyed that scene.
Yep, favorite scene. Okay.
I'll leave it at that.
Yes,
okay.
Let's get into Nutrien here. So this question came in from Ryan, and he says, just wondering if you could take a look at Nutrien or Saskatchewan potash with the rise in fertilizer costs and potential for food shortages coming up. I understand that they are commodity driven, but do they offer value beyond that risk? So let's take a look. Nutrien Ltd, NTR on the TSX, currently trading at a price of about $111 per share, has a market cap of about $61 billion, and they do pay a nice dividend yield, or a little dividend yield of about 2.2%. So Nutrien is the world's largest provider of crop inputs and services, playing a critical role in helping growers increase food production in a sustainable manner. They produce and distribute approximately 27 million tons of potash, nitrogen, and phosphate products worldwide, with potash and nitrogen being the primary parts of their business. So a few key points here. Looking at their potash, or just potash in general, the production by country in 2021, Canada made up about 30% of all potash production worldwide, with Russia coming in second at 20%, Belarus third at 17%, China at 13%, Germany at 5%, and then a few others below. So as you can see, Belarus and Russia made up about 37% of the overall potash market in 2021. And with the European Union and US sanctions on Belarus, supply constraints have led to an increase in potash prices by over 100 or by about 188% increase over the last year, and resulted in Nutrien announcing that it would accelerate the ramp up of its annual potash production capability to 18 million tons by 2025 in response to the uncertainty of supply from Eastern Europe. And this represents an increase of more than 5 million tons, or about 40% compared to production in 2020. Now, looking at their nitrogen division, Nutrien did say that they're advancing previously announced brownfield expansion projects that are expected to add approximately 500,000 tons of capacity by the end of 2025. They also said that they're evaluating the potential for additional low-cost brownfield expansion and emissions reduction projects, with a final investment decision expected over the next 12 months. And longer-term targets, they indicate that Nutrien's annual nitrogen sales volumes could increase to approximately 13.5 million tons by 2027 through the completion of those brownfield projects and some other projects that are under evaluation. Now, looking at the supply and just the overall macroeconomic and tightening of supply and demand picture with the war in Ukraine, I did read the conference call, and Nutrien's CEO said that we are watching the impacts that sanctions are having first on Belarus and Russia, and while potash itself is not sanctioned in Russia, certainly the enabling activities for exports of anything out of Russia at the moment are challenged, whether it's banking or shipping or insurance and so on. So we're looking at duration and how might long this impact happen, and they are believing that it will continue beyond 2022, and they are increasing their own capabilities accordingly. There's also, another good comment by their chief economic strategist, which is pretty long and goes more into detail. But if you want to look at this, you can just go to our show notes and read that for yourself. But overall, the gist is they do believe that there is a good chance that these market dynamics will continue beyond 2022. Now, looking at some recent financial results for Q1 of 2022, these are all in US dollars. Revenue came in at $7.7 billion, an increase of 64% over the previous year. Adjusted EPS was up substantially to $2.70 per share compared to just 29 cents per share. Adjusted EBITDA was $2.6 billion, up 224%. And the balance sheet had about $577 million in cash, and leases and debt were $12.3 billion, providing net debt of about $11.7 billion. So financially, they are firing on all cylinders right now with the increase in fertilizer prices. Now, looking forward to the full year of fiscal 2022, they provided guidance with adjusted EPS for the full year coming in at $17.45 per share, which would be up 180% from last year, and adjusted EBITDA for the full year of $15.5 billion, up from about $7.1 billion, or about 120% from last year. And potash sales and nitrogen sales are looking to increase by about 8.8% and 1.9% respectively on their tonnage. And looking at the valuation here with this guidance, they are trading with a forward price to adjusted earnings of about 5 times and forward enterprise value to adjusted EBITDA multiple of about 3.9 times. So, decent valuations, but of course, keeping in mind that, fertilizer prices have been increased quite substantially. Now, to answer Ryan's question as to whether the company offers value beyond its commodity risk, I believe that fundamentally the business looks strong right now, has solid growth projected throughout 2022, and has long-term targets for its potash division, growing its annual sales to 18 million tons by 2025, which is 32% growth over 2021, and in its nitrogen division, growing total sales to about 13.5 million tons by 2027, which would be about 26% growth over 2021. So the path for growth is there, and the company believes that the tight supply-demand picture remains strong throughout 2022 and potentially beyond 2022. So essentially, if one believes Nutrien's management is right and that the supply-demand picture will remain tight for the next few years, elevating fertilizer prices, I believe there is a reasonable case to be made that the company could offer value over the next 2 to 5 years. But again, even like Ryan did indicate in his question or his questioning, just does the value, is there value beyond the commodity based risk? I would say potentially, but again, if all of a sudden potash or fertilizer prices come down, we will likely see the stock come down as well.
Yeah, good breakdown. I mean, that is one of the things that we will look at, because we get asked a lot about commodity focused businesses, like say, for instance, maybe in mining, like a gold mining company or an oil and gas producer or a fertilizer company. And one of the things that we will look at if you're in a period of increasing commodity prices is, are the financials benefiting just because the commodity price has gone up, or is this a company that is expanding their production as well to further take advantage of that? So that's certainly something that we would look at as well. Balance sheet is another very important factor, particularly with commodity focused businesses, because if you have a lot of debt to service, you're more exposed to the risks of commodity prices falling. But I did notice, taking a look at Nutrien, just at the share price here, big move up in the share price in February when the Ukraine war started, but it's the stock is down about 20% after hitting its highs in April. So is this an opportunity? Well, the analysts right now on the consensus estimates, they're expecting earnings to almost triple in the current year, from about $6 to $17 per share, but then decline going into next year. I mean, and ultimately that's really just, nobody knows what the commodity price is going to be exactly in 2023. But even based on 2023 analyst consensus estimates, the valuation looks reasonably attractive.
You bet. And if anyone is interested, I would suggest, they go and do read the show notes and just like the comment from the economic strategist, because he, kind of delves more into, actually what's coming out of Russia in regards to the amount of tons and what they think is going to, be decreasing in 2022, as well as Belarus. So if you are more interested, I would say go read that quote. It is a long one, or just read their conference call in general.
Yeah, and I think the key risk, there's a number of risks there that Brennan went over, but if we do see, record cash flow, record earnings this year, but if there's a decline, the market doesn't like, a noted decline in the coming year, because, then it's really hard to put a multiple on the stock. If you're looking, even if it is trading at low multiples, if there's a decline of 20, 15, 10, any type of decline and there's no growth, the market likes to buy growth going forward, and that is often why commodity prices companies can trade at really low valuations. They often trade at the lowest valuations when it's the best time in the sector, when there's the most profitability, because eventually the market knows it's going to fall off, and then that's why you can't pay 20 or 30 times cash flow for a business like that. You're paying 5 or 6 times, because cash flow is uneven over the long term and often can go negative in some of those businesses. So let's move on to the next company. I think is a good synopsis on Nutrien. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Docusign, Aaron, you got a lot to say about this company. We'll just let you get into it.
I do. Let's dive into it. Docusign Inc. The symbol is DOCU on the NASDAQ. It's trading right now for about $56, a market capitalization or market value of $11 billion. What they are, Docusign provides a cloud-based software that allows users to review and sign documents, legal documents, remotely. I've used the service many times myself. I find it to be very easy to use, very convenient, very useful. And the company was founded in 2003, and it just went public a couple of years ago in 2018. So the share price of Docusign has been crushed lately, along with the rest of the technology sector. Price is down over 30% over the last 5 trading days, down 80% over the past 12 months. And if you look at where the company IPO'd, it IPO'd at about $45 per share back in 2018. So at 56, we're actually almost back down to the original IPO price years ago. At its highs, the company was trading at $300 only less than a year ago. So this was one of those highly visible, widely touted, high growth, high valuation software stocks. It performed extremely well during the pandemic as everybody was locked down. Business was being conducted online, so its technology was extremely useful. As I said, I've used the service personally many times. But like so many of those once beloved software stocks, the company's share price has crashed. And this is really a crash. I mean, down 80% in a year. So the question that I really want to answer here is in spite of the crash aside in the stock price, how is the company performing financially? What's the outlook? And does it now offer good value here after declining 80%? So taking a look just at the recent financial results, the company put out its first quarter results in May. Revenue was up 25% to $588 million. Non-GAAP earnings per share declined 14%. Free cash flow was up 42% to $174 million. And the company ended the first quarter with $967 million in cash, $872 million in debt. So it does have a small net cash balance, healthy balance sheet. Looking forward, the company has provided guidance for the current fiscal year. They're expecting total revenue between 2.47 to 2.48 billion. So that would be 21% growth at the midpoint for revenue year over year in the current year. Non-GAAP operating income is expected to be about 395 to 446 million for the year, and this would put that about flat. Profitability based on non-GAAP operating income flat year over year. Looking at analyst estimates, analyst consensus for earnings in the current year is $1.74. So this would be down 12% from last year when the company reported $1.98 in earnings. Analysts also expect growth to resume next year with earnings per share of just under $2, which would be an increase of 14%. So currently Docusign trades at about 23 times trailing free cash flow. So free cash flow that they've reported over the past 12 months, which is 496 million. And the company trades at 28 times the analyst consensus earnings per share estimates for next year. When you compare this with the company's valuation a year ago, it was trading at 250 times trailing free cash flow. So this is when the market value of the company was 56 billion as opposed to $11 billion per today. So huge change in the valuation. It's the price to cash flow valuation today is about a tenth of what it was a year ago. Company still remains profitable based on reported earnings. Revenue is expected to continue to grow. It has a great brand, a useful product and service, a healthy balance sheet with some net cash. So what is the issue with Docusign? What should we do going forward? Is this an opportunity to buy an innovative software as a service technology company at a highly discounted price? I wish I could say yes. Unfortunately, I'm going to have to say that the jury is still out. So one thing that I would certainly do with a company like Docusign, what I would like to do is break apart the business, the competitive landscape, their market share, how the market share is growing. But I'm going to leave that analysis for now. And the reason for that is because I want to focus on another part of the company, and that's the company's stock-based compensation expense. So stock-based compensation, this is a major issue in the technology space. It's essentially when you're paying your employees and your executives with stock options as opposed to cash. So a portion of the compensation comes in the form of stock options. This is something that companies like to do because on one hand, it aligns employees with the future success of the company, but also it's not a cash outflow when you provide the stock options. It's only a cash outflow when those options are exercised. So it's easy to essentially overinflate your earnings per share, your cash flow, your free cash flow by using a lot of stock-based compensation expense. And there's no other segment of the market where this is more of an issue than in the software space. I mean, software companies use stock-based compensation as a major component of their overall employee and executive compensation. So this is a really complicated issue. I think that it deserves multiple segments of its own to really discuss properly. And I think that this is something that I think that we should discuss more deeply. But it's just for our discussion here. It's a thematic issue that I think all technology investors do need to understand at a fairly basic level. So in some cases, the payment of stock-based compensation doesn't really overstate earnings that much. But in other cases, for some companies, the overstatement can be substantial. And I think that is the case with Docusign. So just to give you an example, in 2021, Docusign's stock-based compensation expense was over $400 million. Now, this was about equal to its non-GAAP earnings and about 80% of its reported free cash flow. But what's important to understand is with stock-based compensation, because it's not an actual cash expense, it's typically adjusted out of non-GAAP or adjusted earnings per share. It's not considered in the free cash flow calculation because it doesn't go through the operating section of the cash flow statement. So really what you have is you have companies using this as a form of compensation, but then not recording it as an expense. And this is a very controversial issue, but all technology companies essentially do this. So as an analyst, you need to be aware of how much of an adjustment is being made for this type of expense and whether or not you need to readjust this back in. So if you factor in the stock-based compensation for Docusign, and this is something that many people, including Warren Buffett, think that you need to do, this essentially brings their non-GAAP earnings per share from a strong profitability down to essentially break even. And it brings their free cash flow over the past 12 months from just under 500 million to just under 100 million. So significant difference that we're seeing here. It brings the free cash flow multiple from 23 times to about 100 times. So all of a sudden, it doesn't look quite as cheap as what we thought. And of course, imagine how expensive this company was a year ago when it traded at 250 times the company's reported free cash flow. So as I said, this is a very complicated issue. There are ways to identify what the actual cash impact is, making additional adjustments. But in the case of Docusign, it's a major issue that really needs to be investigated further. Now, because the share price is down so much over the last year, this may not be an issue for the company because their options won't be in the money. People won't be vesting until the share price recovers. But it could also create a problem for Docusign where some of their employees, and this is going to be an issue across the technology sector, some of their employees may get the feeling that they're undercompensated because their stock options aren't worth much and are so far out of the money now. And they may demand more of their compensation in the future to come in the form of actual cash, which of course is expensed both through cash flow and on the income statement. So, Docusign, I think it's really interesting. The fact that it's well below pre-pandemic levels, almost back to its IPO price, in spite of continuing to grow its revenue and having such a great brand, I think that there's an argument to be made that it's an interesting company. But rather than just assuming because it's pulled back so much that it now must be good value, I think we also have to consider that even pre-pandemic, this company was trading at a extremely high valuation. And once we make adjustments, it may still be trading at a relatively high valuation today.
Yeah, I think it's a really good summary that you provided there. And it's shocking to see in many of these companies, with the massive destruction of capital there, the massive decline in the share price, that it's still 28 times. And when you factor in the stock-based compensation, it could be significantly higher than that. The questions would be too, what is the pace of revenue or cash flow growth going forward? If I look at, adjusted earnings estimates from 2023 to 2024. Now, to me, given the landscape, those are just guesstimates, but it's about 14% growth rate there. Well, at 28 times, it's still not cheap. Like it's even though you'd think, it has to be cheap at this point, it's a quality business here, but is it trading at historic discount levels? It doesn't look like it at this stage. The other factors would be competitors. I would note that Adobe has a Docusign or a digital signature type product that is well thought of as well. And Adobe is certainly a larger name, has more free cash flow to use at its disposal to forward that product. And there are many other signatures. Box Inc., a company we're looking at, has a digital signature product as well. So, there's a number of, there's PandaDoc and HelloSign. There's a number of competitors. Now, every business has competitors. It's not the only reason. Docusign is a leader in this segment, but when you have a company like Adobe with a good foot in the door as well, it is something to watch as well in terms of what their growth rate can be going forward and how high are the switching costs to another digital signature company. I'm not certain on that, but that would be something to investigate if you're looking at the company as well. So I think that ends our show. Any further comments, guys?
No, I think that's good. We discussed a lot.
Yeah, we went through a lot.
Yeah, I think that should be good.
We're going to, we'll continue to take your questions. Keep those questions coming in for our Your Stock, Our Take. If you want us to compare a couple companies in like industries, debate one company, let us know. We'll do that on an upcoming podcast. Keep rating and reviewing us on iTunes. And we'll continue to provide this content on a weekly basis. I look forward to speaking with you next week. And as always, I wish you profitable investing. Thank you.
Profitable investing. Thank you.
Thanks, everyone.